I think on the mining side, what I would say is the fire was already burning in tight supply demand with energy transition, and COVID infrastructure spending is just going to throw sort of gasoline on that fire.
We spent kind of the last 9 months to 10 months going up, and it was generally good for all commodities. We think that we're getting to a point where you're going to need to be a little bit more selective on which commodities are more exciting.
So you have a lot of things that have happened on the supply side that have curtailed supply. Obviously, a lack of equity investment or interest has exacerbated that problem. And as Carl said, you know, COVID and all the fiscal stimulus, as Nate mentioned, is like gas on a fire because it has an almost immediate impact. And the supply side just can't react that quickly.
Well, hello to everyone tuning into this discussion that forms the headline session for our one-to-one Mining Investment America's online event. We're going to be addressing some of the main topics facing metals and mining at the moment and hearing from some of the leading investors in the commodities sector. So, in our guest panel, I have with me today Carl Tricoli, founder and managing partner of Denham Capital, Nathan Ebeling, partner at Ospraie Capital, Greg Caione, managing director at Sprott Inc., and also managing partner at Sprott Resource Lending. Gentlemen, thanks very much for taking time to talk with me today. Carl, could I turn to you first and just get the view from Denham Capital, actually, because you cover not just metals and mining, but energy, oil stocks as well, etc. You know, is this a COVID-19 triggered commodities super cycle that we're experiencing now, or is that perhaps a bit premature to be calling it a super cycle? And in fact, it's more of a bull market with some very different conditions to the 2000s led China led boom. Just wanted to get your view on that.
Thank you, Adam, and thank you very much for the sponsorship of this event. To answer that question, I would actually break it. I'll deal with oil and gas somewhat separately than the mining sector. I'll start with the mining sector. I think what I would say is that COVID is really going to be pouring gasoline on what I would say was already a fire burning from the overall energy transition. And so I think that there's a couple of factors at play here. The first we're all familiar with, which is sort of 10 years of underinvestment in the sector, which is going to constrain the supply side. And then you have an energy transition happening with all the needs that we know are going to come in the form of copper and battery metals and a lot of other things as we transition to electric vehicles and renewable power. And then what you have, so that was already creating a very, very tight supply demand scenario. And then what you have with COVID is the potential for infrastructure spending. We can argue about how much of these infrastructure spending bills are actually being spent on infrastructure. But suffice it to say, if you're going to throw $2, $3, $4 trillion into economies, you are going to drive some additional need for these raw materials. And so I think on the mining side, what I would say is the fire was already burning in tight supply demand with energy transition, and COVID infrastructure spending is just going to throw sort of gasoline on that fire. And I don't know what constitutes a super cycle. Copper's now 420. So, yeah, we're seeing some real impact there. The oil and gas fundamentals are a little bit different because there, I think in the medium to longer term, I do think you're going to see, sort of peak demand. And as the world transitions, I think there is a possibility in the medium term, what you're going to see, in the short term, what you're going to see is the potential for increased demand as travel and everything picks back up in the face of what were severe supply curtailments as production declined precipitously. So you may actually find yourself in a scenario in the next, 18 to 24 months of oil prices being exceedingly strong. But then for the medium to longer term, I think that wanes as the world moves away from internal combustion engines.
Yep, absolutely. Thanks. That's very succinct and very bullish in the near term. Nathan, could I turn to you and just get the view from Ospraie, because as far as I understand, you also cover other commodities as well. And I ask because we're going to go on to the energy transition and other factors that are driving the mining sector. But what's your take on the bullish mood of the market at the moment, and what's the outlook further down from Ospraie?
Well, yeah, at Ospraie we do cover commodities and the related industries across the board, from energy, metals into agriculture. And you know, Carl, I think, stole some of my thunder here in terms of our view, but we share a very similar view. I would augment some of the things he said in terms of the view. We think that you know, you came out of a 8 or 10 year bear market in commodities. I always like to kind of pin the top, and it looks pretty neat from a chart perspective, at the Glencore IPO in May of 2011. It was almost, you know, like magically prices held up till then, or were held up till then. And, you know, that IPO happened and the world was ripping with what was going on with a huge, at the time, China stimulus bill, and kind of the continuation of the previous decade cycle kind of running out though in the last innings. So from there, and obviously when we talk about a broad spectrum of commodities, it's, you know, there's many cycles in there and all of them aren't bearish for 8 or 9 years, but largely speaking, you know, CapEx peaked in that period. CapEx has structurally been coming down. CapEx is only lower when we have lower commodity prices. That's certainly been dead true for metals across the board. There's been a mini bull cycle in there for lithium and cobalt. Obviously, gold performed a little bit earlier, but generally speaking, it's been a challenging time for commodities. We looked at it, and coming out of COVID, and you know, we were sitting in this bear market, and we looked kind of across 30-ish balance sheets, and we looked at it and said, holy cow, it's a really interesting time in commodities. We have a whole bunch of commodity balance sheets that over the next 2 or 3 years are unsustainably cheap, based on what we think supply and demand are, which I think generally many of us agree. We actually went out, just to kind of give you what our view is and was at that point in time, and last summer launched a long focused commodity fund, and we launched it for a kind of a 2 to 3 year vehicle that was going to invest long only in commodities during that period, not indexed to anything. We're just like, we've never done that in our 20-year history. Right? We thought the cycle was so compelling, not only from balance sheet by balance sheet, but on top of that, as Carl said, the what we like to say, the macro tailwinds in there by coordinated global stimulus of unprecedented magnitude that dwarfs what we saw in 2009-10. So it kind of, and the greatest prospects for inflation of any point in time that we've seen. So, you know, to sum it up, that's we're very bullish on commodities, and we're very and have been for the better part of the last year. I think I'll throw in one other point, and then I'm certainly happy to hear what Greg has to say. But the other point is, you know, we spent kind of the last 9 months to 10 months going up, and it was generally good for all commodities. We think that we're getting to a point where you're going to need to be a little bit more selective on which commodities are more exciting. The first phase of it, everything's performed. Now we think there's going to be a little more alpha to be had than beta.
That's interesting. Excellent. We can maybe home into that in a bit. Could I just ask quickly though, before I move to Greg, what's your sort of weighting for mining versus other commodities within that?
We have no, the short answer is we didn't want to index to anything, because indexing in many ways is for what we're trying to do. We're trying to make money. So indexing is a losing battle in that. We used to run by client request. I was a co-portfolio manager of $1 billion+ commodity long only fund. And that was like, hey, we're already benchmarked to GSCI and AIG. Can you outperform it by 300 or 400 basis points, right? So we were doing a good job if commodities were down 20 and we were down 17. That's not what we're doing here. This is absolute return. In fact, the way we've set it up is that we only make an incentive fee. There's no management fee. So if we're not right on the thesis and then we don't add alpha by picking commodities, there's no fees for us. So to answer your question, we haven't set it up that way. When we go to the metals piece of it, we have said because of the inflation traction that we want, we will keep a portion of it in precious metals and have a minimum threshold of kind of a core position in precious metals, which will rotate selectively. And on the rest of the metal side, we've been involved in both copper and aluminum primarily. And as part of a structural demand growth story and what's going on with some of the energy transition, decarbonization piece of it, which I'm sure we'll dig into in a bit.
Yeah, absolutely. Excellent. Thank you. Greg, how's it going? Could we get the view from Sprott now as well? You're an investor and a financier. What's your outlook at the moment?
Yeah, sure. Happy to, Adam. And again, thanks for inviting me to join the panel this morning. It's hard to top the imagery that both Nate and Carl have put forward. I do like Carl's imagery of throwing gas on a burning fire already. I think that really does sum it up. So I won't go through and repeat everything the guys say. I might expand like Nate did a little bit more on the supply side. Nate touched on it, where there was a lack of capital investment in the sector for many years. I think that you have that. It is harder to find deposits. It is harder to develop deposits. We're going to talk about ESG a little bit later on. So you have those elements. You also have a little bit of national resource nationalism in play here. So you have a lot of things that have happened on the supply side that have curtailed supply. Obviously, a lack of equity investment or interest has exacerbated that problem. And as Carl said, COVID and all the fiscal stimulus, as Nate mentioned, is like gas on fire because it has an almost immediate impact. And the supply side just can't react that quickly, and it just never will. So, COVID, I don't know if it's the direct impact. The wood, the tinder, the fire was burning, as Carl put forward. This just really blew it up. So yeah, we are fundamentally positive. I agree with Nate when he talks about you're going to have to be a little bit more selective. At first, all boats were rising quite quickly. I think you're going to have to be a little bit more discreet. Probably the same thing you've had with stocks over the last 10 years, where you could be a passive index investor, and now things start to seem to be changing or moving towards. You have to be a little bit more selective how you pick individual stocks.
Yeah, certainly. Okay, that's great. It's a good outlook, but it looks like we're coming to an interesting point of where things will move next then. And I guess it leads to my next point on the energy transition and how definitive this really is for this decade, I suppose, for mining. It seems to bring a lot of pressure on the sector to deliver, but also a lot of opportunity if you can be positioned in the right companies, the right commodities, etc. I was reading just this morning about Biden sort of triggering a great US energy reset. He's got an international climate summit sometime this week or something. And, it's anticipated to turbocharge clean energy sector jobs, etc. I just wanted to ask the panel's view on the pace of this energy transition, whether it's going to be achievable with this sort of underinvestment that we've seen in mining over the last decade, and then bringing new mine supply online and the capital required to get quality produce into of these transition metals into production. Carl, could we start with you?
So I think that this is going to occur faster than I would have expected a year ago or 2 years ago. And I think that there are two factors coming together that are accelerating, at least directionally, where things are going. Because I think left to their own devices, consumers would be adapting these technologies more slowly than I think people would necessarily want. I think two forces are occurring. The first is sort of supply driven, if you want to say that, in that now essentially every automobile manufacturer has announced a date specific that range from as early as 2030 to, in some cases, a little bit later, stretching out to 2040, when they will no longer produce internal combustion engines. And so consumers just won't have a choice. I mean, if you want to buy a new car, you're buying some form of an electric vehicle, or at least a hybrid. And that's not something that we had 2 years ago. And so I thought the rate of pickup in that would be a bit slower, but now it's being forced really by the auto manufacturers. And then the second thing, I think, especially with the transition in the administration that you've seen in the United States, I think government intervention is occurring at a much more rapid pace. That's certainly true in Europe. It's been true in Europe for a little bit longer, and now I think that's the expectation that you could see in the U.S. And so, I think what I would say is the adoption of the energy transition is going to happen more rapidly, and by more rapidly, I'm saying, over the course of the next 10 to 15 years. However, having said that, and we've all been touching on this, I think the tempering factor as a practical matter is going to be the supply chains. And the transition to all of these things is going to happen only as quickly as the supply of raw materials will allow it. And so I think, while governments and auto manufacturers and everybody is sort of pushing in that direction, it'll be tempered somewhat until we get the supply chain up to speed with what governments and others want.
Yeah. And do you at Denham, in your analysis, do you have a view on sort of where the greatest tightness is going to be, and sort of where you want to be positioned within that? Obviously, copper, everyone's very bullish on, but also agree that there's not a lot of supply going to be coming online yet. It's so fundamental. Do you have any sort of view on where the tightness is going to be in particular?
Yeah, I mean, interesting. So absolutely. So copper, obviously, as everybody already knows, battery metals. I mean, even things like tin. I mean, people don't recognize. I mean, the price of tin, like since March, has gone from like 14,000 to 22,000 because tin is what's used in solder. So think about the connection on every single wire globally, and you need tin. The other thing that's very interesting is metallurgical coal, because every single thing, where every wind turbine, every solar panel, all of these things require steel, and which there's two basic ingredients, right? Iron ore and metallurgical coal. What's happening though is that metallurgical coal is being lumped in with thermal coal, and everybody has put a gigantic X through coal generally, and nobody wants to invest in coal. And so you're seeing a tremendous underinvestment in now, unfortunately, metallurgical coal, because that's being painted with the same brush. In addition to that, there's just not, I mean, there's a lot more thermal coal around than there is, metallurgical coal. And so another place where I think you really will begin to see some supply constraints are going to be in metallurgical coal.
Yeah, it's very interesting. Yeah, sort of right in the crosshairs of the ESG conscious pools of capital.
Well, it's an interesting thing, because you're waving the banner that about wind turbines and solar panels, but unless you're planning on making them out of bamboo, you're gonna need metallurgical coal.
Anecdotally, to add to Carl, and to reinforce that, you have a problem when the Australian banks no longer want to bank not just thermal but met coal companies. I mean, Coal
Right.
is Australia. The Australian banks have always supported it because they knew they had to. It was in their backyard.
Yeah.
I'm hearing that not only are they getting out of thermal, but they're moving away from met coal. That doesn't sound good.
And I think just to kind of piggyback on that point, there's some great structural trends here, right? And there's some great structural trends in fossil fuels. And when I say that, for example, thermal coal, right? Like thermal coal is very undesirable. And structurally, certainly in the US, has already rolled over in recent years, and in other developing nations will roll over, continue to roll over as well. But I think what's really interesting is if you look at it, right, everybody's a seller of thermal coal or coal assets, right? Because think about it this way: the large BHPs or Anglos of the world, their investors and Glencores don't want them to have coal, right? So they're sellers. The private equity groups of the world, their investors and allocators of pension funds and sovereign wealth don't want them to have fossil fuels, especially coal. So there's no capital going to the space. And then if you want to, there's no capital going to the space, which if you are able to allocate capital to that space, there's going to be some spectacular opportunities in some of the fossil fuels in the short term, where you're going to be able to get free cash flow paybacks in 3-4 years and own the assets for free. And maybe there's not a ton of terminal value, but there's going to be some value in those. And maybe there's some sort of disruption, or we're not able to create this energy transition as quickly, and we need more, coal or other fossil fuels. Conversely, I think what's really interesting is people have been super bullish on nickel, right? Or we can choose lithium or something like that. And our opinion is nickel is in a big surplus, right? It was in a big surplus last year. It's at these prices. It's in a big surplus this year. It's in a big surplus next year. Now, and that's a function of not that nickel doesn't have a great 10-year demand story. It's a function of the fact that that demand isn't that robust here and today, and we're sending a price signal that is here and today for the Indonesia and the Chinese to continue to produce a ton of NPI nickel, right? And at the same time, the Indonesians tell us that they can actually produce battery grade nickel out of that, and there's a process to do that, right? So and by the way, doesn't cost them $16,000 to do it. It costs them $10,000 or $12,000 to do it. So those are kind of some of the inefficiencies, which I think are opportunities, or can be pitfalls that we're seeing on both sides of this energy transition, which I think are really important to appreciate. I mean, listen, we all had a front row seat to what happened in lithium in kind of the 2017-18, right? You give the guys a bunch of capital, and lithium producers can find lithium. Now, it doesn't go perfectly, and there's some chemistry problems, and there's some brine issues and whatever. But we can meet the demand growth if the capital comes in with lead time in some of these, and there's certain things. Whereas I think, as all of us have alluded to and agree, there are some that are really tough. Copper's really tough, right? It takes a long time to develop a copper mine and build out the deposits, and the demand profile looks pretty good.
Yep. So Nate, you don't subscribe to Musk's tweets that nickel's quite hard to find, or maybe sustainable nickel that he wants to put into his batteries, right? That's not quite right.
I don't subscribe to it that it's hard to find. I think we can argue about what sustainable nickel is. Like, the stuff they're producing in Indonesia isn't exactly green, right? It's not. Producing NPI isn't exactly, has a pretty big carbon footprint. But so I don't know exactly how that's going to play out. But if you want to produce nickel, we can produce it. We're producing all the nickel we need and more right now at these prices. maybe we need to go to $25,000 nickel for 2025 or the back half of the decade to continue to do it. Maybe there's a combination. Maybe there's a question to be answered on what green nickel is going to trade at as a premium and who's going to pay for that. I think those are fair questions to ask, but you know, nickel's not a problem here the way we see it in coming years, in the near coming years.
It's interesting. So there's going to be premiums for the sort of the high quality product that's going to go into the real high performance EVs, and then you're going to get your simple sort of LFP type quick.
There was I don't know if people saw it, but there was a great article on Bloomberg today about Apple and green aluminum. I'd encourage everybody to take a look, but they've been working on a project effectively with Rio and Alcoa since 2015 to produce, because producing aluminum is pretty dirty, as you know, when you're using all this anode. And they've been working on a project, and they haven't commercially produced it, but they've produced, you know, with some success, the prototypes without the carbon anode. So it's a good article. Is Apple going to pay a premium? Yes, that's 14,000 tons of nickel or aluminum they use in a 65 million ton market. So who's going to pay it? How much is it going to matter? I think those are big questions to be answered, which we think some of that is going to happen, but underwriting that in the investment thesis is, I think, tougher at this point.
Yeah.
Just to expand on the whole rotation the guys have been talking about, there's clearly a public push towards going green, going towards energy. And yeah, they'll probably get it wrong as they try and institute the policies to get it done. For me, I think the reality is going to be much different than what they hope to get out of it. There's no doubt there's a push towards it and it's going to go there eventually. I just think the time scale is going to be different. And for that reason, I kind of like some of the liquids out there. Whether it's, you know, crude or anything else, I kind of probably like it a little bit better for longer. There's just been such supply destruction over the last, it's really been brutal since 2014. It did a little bit better. It was 14 or 15 when oil prices really tanked. And it got obviously a lot of supply destruction over the past 12 months. So I kind of like oil, though we don't play the oil and gas space and invest in it. I kind of like that for longer. I appreciate where Carl's coming from. Short-term good, maybe intermediate, okay, maybe there's a peak in there. But from what I anecdotally hear, right now demand for oil is as good as it was before COVID, and the airline industry hasn't even taken off. So that's the short-term thing I think Carl talks to. But again, when I look at the reality of re-rolling out into the green side of thing and all the car companies going towards, you know, no more gas combustion engines, fair enough and fine. But I think the reality, and Carl, you talked a little bit about the reality, or are you actually going to be able to do this? I think that's going to play out differently and take longer to happen. And I think one of the big things is great. You can have as many electric car produced by the manufacturers as you want, but until you have the infrastructure out there to support people actually using electric cars on a daily basis, you know, there's a lot of gas stations to be replaced out there. And I don't think that's going to happen over 10 years. Even if the government throws billions at it, it's a lot of digging up streets and regulations and everything else. It's going to take time, I think, to unfold. It will.
Well, and to that point, though, I mean, you can just see the train wreck coming because, again, I go back to the auto manufacturers that have now put themselves on a schedule. And so we all know that, you know, they're looking literally 10 years ahead of time, you know, in terms of changing production facilities and doing the things that they're doing. And so once you sort of push that button, you're sort of moving and you're going down that path.
Yeah.
But, what's not going down that path on the same trajectory is exactly what you said, is the whole infrastructure that you need, to support it. I was, reading a little bit of a humorous article yesterday, the title of which was, "I bought an electric vehicle and I wish I hadn't." It was sort of just talking about the travails of, getting from point A to point B, and they sort of had it mapped out. And it was, they got to the charging station and the charging station didn't work, and they had to find another one. And, long story short, a trip that should have taken X, took 2X, and, et cetera, et cetera. And so, will ultimately those issues be resolved? Yes, of course. They're just not going to be resolved in the time frame that people are thinking. And as we're all talking about the major theme, the supply chain is absolutely not going to be keeping up, and it's just going to have, the impact of a super cycle.
You're good on visuals. I like the train wreck one there too, Carl. So I agree.
Gasoline and a train wreck.
Train wreck. We're doing well. I'm all for it.
I'll throw some gasoline on your comments. I mean, forget what the automakers have said for a moment. Look what the oil companies have said. That they're going to not grow oil production, the majors, and that they're going to transition out of fossil fuels over the next 15 to 20 years, right? So what do you think the CapEx cycle is going to be for oil? To your point, Greg, like, people aren't going to quit driving their car because they don't want, they want to support the green. It's like all of, many of the famous people in Hollywood pundits who preach for the green, and then they fly their G5 across the country, right? Which has a pretty big carbon footprint, I think.
The actions don't meet the words. I agree.
Yeah, so, we all like to talk about it until the rubber meets the road and it inconveniences our lives.
Yep.
And listen, guilty, right? I'm not gonna try and play that. But the background for oil prices is pretty constructive in the near term. I don't know what oil is going to do in the next 10 years, right? There's so many variables and the Kona outcome's so wide, but in the next, 2 or 3, and maybe it's 4 or 5, oil's not going to be, a sub 50 commodity. I don't think, because there's no investment there. There's a very limited investment going.
And it's interesting as we talk about some of this inflation and how it may impact the supply side of the same commodities. If you have a higher rising oil price, I think you already see the higher rising iron ore price. You're going to all of a sudden find that projects that, when they had a good commodity price, but the input and prices to building these things or running these things weren't as high, they got built. Maybe some of them shouldn't, but they did. And you're entering a new reality where I think a lot of the feasibility studies that are being developed out there, and when people go to redress the cost side of it, they're like, maybe this isn't as good as we thought. And it's fun to go ahead, Carl.
No. And I mean, an interesting thing, when I look at oil and what the oil industry was able to do, was a massive increase in supply through the technology around the Shale Revolution. Now, the Shale Revolution is a combination of two things. It's a combination of technological breakthrough and Mother Nature, because essentially what you figure, people talk about fracking. What you were really doing is you were moving from producing out of the sandstone to producing from the source rock. And so, which is a much tighter, denser material. And so, the Shale Revolution is two things. It's technology, but it's also now, essentially new rock to go produce from. When the analogy to me is copper. Copper to me is almost like the oil to the energy transition, because, as we all know, I mean, an electric vehicle uses like 3 times as much copper as an internal combustion engine. More importantly, it's the infrastructure of the things we're talking about. It's the charging stations. It's the grid. We all saw what happened in Texas this winter when we had a freeze. And there's been such a, one of the contributing factors was a transition to renewable power. And so, you just had a massive collapse of the grid. So all of that takes copper. We all know, I don't see any equivalent of the shale revolution occurring in copper to sort of bail things out, because you don't have the same geologic context that you do in copper that you had that enabled the shale revolution in oil and gas. You might have some technological breakthroughs, but there's no such thing as the source rock in copper, to go to. And so that's where I see some real challenges and real potential for roadblocks. It takes 10 years to get a copper mine from, discovery into production. It's not like you can flip a switch.
Yeah. And I think on the copper side, just to pile on there a little bit, we think copper needs to go to a disincentive price, not an incentive price. When you think about it, and what does that mean?
To encourage substitution,
thrifting, or just demand destruction. And if you think about it, what's that mean? Well, I mean, listen, I don't think we'd have a hard time arguing that $4+ copper is an incentive price for production. Any of us, I think all of us would generally agree. Now, the timeline on that, no matter what the incentive price is, the timeline to actually get materially more tons just can't move that quickly, right? Which kind of ties to the disincentive price. We look at the analogy of rhodium, which has been in the news a little bit in recent months because it's gone to crazy prices. The old high in rhodium back in 2007 was $10,000, which was astronomical and changed a ton of behavior because car companies spent the next 5, 6, 7 years thrifting out as much rhodium as humanly possible and substituting it. Rhodium now today is at $30,000 because 85% of rhodium goes into the auto industry. What's going on in the auto industry? Tighter emission standards. What's been going on in long cycle PGM mining, which is even longer cycle than copper to produce new PGM mines. So you have an analogy that I think is, why isn't copper going to 30,000? And is it going to stay there? Is it sustainable there? No, but it's not about an incentive price. It's about, we're going to have to really force hard decisions on the demand side, we believe.
Yep. It's fascinating. It's it's a real challenging scenario. I hear that it's going to happen. The energy transition's here and underway, but for all the challenges that you've outlaid, it's much more nuanced than simply it's happening quickly. So I wanted to touch on how we're going to get there then, or how it's going to play out, particularly around the amount of capital that's needed. Okay, the supply might not come online quick enough in copper because of the lack of discoveries and the lead time, the 10 years to get a mine into production. But is there enough capital going into these different metal groups anyway? And has ESG slowed that down, or could it eventually accelerate it in terms of something like lithium, for instance, a Lithium Junior making it into an ESG mandated fund, for instance? Is that something that we might see more of? Or is it a case that ESG is taking capital off the table because mining's too dirty, for instance? Where are we at right now with those sort of capital flows coming into the sector to get us to this energy transition?
I mean, to your point, God giveth and God taketh. So the ESG mandate does push you towards some of the battery metals for sure, but it also it's such a mandate that it curtails who the money can go to. In the balance, I think it actually hurts the amount of capital going into the business. Yep. If you had to add up both sides of it, just because the policies are so blunt and so strict, and everyone's adopting it. It's like it's the thing to do, obviously, over the last 5 to 10 years, and it's getting pushed harder and harder. It's not easy being compliant to ESG. If you're a mine, yeah, you can go there, but I guess beauty's in the eye of the beholder on what that fully means. For me personally, I think that this move towards ESG is going to hurt the amount of capital going in, even though it's going to add in some spaces. So it may redirect here and there, but I think on balance it hurts until people wake up and start to really understand what it means and how it needs to be implemented. Yeah.
I think maybe to unpack that, I mean, there are really two parts to your question, and to sort of unpack it a little bit. As it relates to ESG, first I would agree with Greg, just that, things are just going to take longer to bring into production because of ESG considerations. And from a global perspective, that's honestly probably a good thing, and people are being more careful, and that's all good. Just as a practical matter, that just means that projects take longer to be permitted and to bring into production, which just further exacerbates the supply issue that we've been talking about. And on the other hand, I think actually it's a little more nuanced in terms of how that impacts capital formation. In some respects, for example, if you look at what's going on in the SPAC market right now, there are SPACs being created specifically around sustainable mining, battery metals, and things like that. Robert Friedland has put a SPAC together, Mick Davis has put a SPAC together to focus specifically on things related to the energy transition. And so I think what you're going to see is, on the one hand, the investor community is going to, let die on the vine things that are, not complying in the ESG world, and in a sense rewarding things that are. And you're going to see capital formed around, battery metals, things that are required for the energy transition supply chain, and for things that are being done sustainably. The example that Nathan was using with Apple, for example, what you're going to see is investor capital coming in to encourage things that are being produced sustainable. So I think what I would say is, overall, ESG is going to change a little bit the way people think about people think about capital formation.
Yep, absolutely. Nathan, do you have anything else to add to the capital formation journey and how nuanced that's going to become as ESG sort of?
I don't have the one other thing I'd add. I generally agree with what both Greg and Carl have said. It's going to raise, not only is it going to weigh on time, which will be supported to price in some of these strong demand growth commodities, it's going to also raise the price or the cost curve, right? Because when you have to build better tailing dams, or when it takes you 50% longer to get a return, the same dollar return on capital, that's a lower IRR, right? And investors demand higher or certain IRR levels, or at least want to underwrite that. So I think it's going to make the cost curve go up, and ultimately commodity prices go up. I also fear there's going to be I think there's a lot of, I think overall ESG has a bunch of benefits. But I also think there's a lot of things that need to be refined, and there's some holes in it, right? Like, we talk about electric vehicles and how efficient they are, but when the power comes from coal, what's that really mean, right? So I think it used to be, we used to talk about it in the world of ags in terms of ethanol, right? Actually, ethanol was a really inefficient calorie by the time you got done making it, but everybody labeled it green. So ESG is going to label a bunch of things in certain ways and view them in certain ways, and companies are going to position in certain ways. I don't think it, I think it will lead to several inefficient uses of capital and allocations of capital. Overall, I think there's a lot good with ESG, don't get me wrong, but I do think there's going to be inefficient capital allocation because of it in terms of getting to, ideal outcomes.
The other aspect that you touched on, Adam, in your question with respect to capital formation is, despite all of what we're talking about with these fundamentals, it is still today relatively difficult to form capital around a development project, particularly for juniors. The exception to that is probably in the gold world. And if you have a gold project, there does seem to be capital relatively readily available for development in that sector. When you move to base metals, kind of sparse, you can come by it. I think what we're seeing, and Greg can certainly opine on this. You're seeing capital coming from alternative sources. The streamers and royalty providers are providing more capital, I think, than they have traditionally. But to get a project built, you're having to scrounge around for equity. Greg's maybe going to lend you some money, and then he's going to, you're going to go to a streamer and they're going to put in, you kind of have to cobble this whole thing together. So, I mean, capital is still, and then if you have kind of an off-spec project that's either in a weird jurisdiction or it's a specialty metal or things like that, then it becomes exceedingly challenging. And God forbid you have a metallurgical coal project. And so I think there are still challenges on the formation of capital. So what you're going to see you're going to see first people move to just producers generally. I'm going to play copper because I'm going to invest, in a copper company, producing copper company. And it's going to start with majors and then go to juniors. At some point, if generalists come in, they're going to transition more toward big name companies at first. It's kind of last on the list are juniors with, projects that need development capital. And it's just going to be a while before you see those people get some capital until you see some real, people connect the dots between supply chain and what's going on in the world.
Yeah, I think you nailed it. Go ahead, Greg.
I was going to add to that. To your point, I don't think the junior developer sees capital from the generalists probably for a very, very long time, if ever. So you're stuck with small pools of capital from specialists to supply at least the equity side and the debt side. It's tough to be a junior developer.
Yeah, I think
the further afield you go from gold, the tougher it is.
Yeah, I think you've seen some capital come into the sector, into the mining sector, but it's coming to large cap, right? And why is that? Well, if you're a generalist and you're not as focused on it, you're like, okay, Freeport equals copper, right? Or, Mattel equals steel, or so you can kind of go down those lists, and those are the safer places to go. But it takes a significant amount of work to go down the curve into the juniors. And investing in juniors hasn't been a great investment over the last 15 or 20 years unless you've traded it really well, which ultimately will probably create a great opportunity in juniors in coming years, because we're going to need some of that exploration capital. So if you can find good projects and management teams that can execute, which, listen, is a challenge in juniors, right? And that's not shooting bullets at any of the juniors. It's just a really, really hard business, right? The stats just are that most of these projects don't happen on time or on budget. And that's whether you're doing it at Rio Tinto or you're doing it at a $50 million market cap, company.
But this sort of leads to my last question that I wanted to address. The companies have, across the tiers broadly, been performing quite well, if I'm not mistaken. What's your view there? As shareholders, as owners of companies. Management teams have sort of displayed good capital discipline, doubled down on costs. M&A hasn't sort of flooded back yet with some sort of wild acquisitions. So the mining sector is presenting a slightly more attractive proposition to new investors than it was. Maybe it's just taking a lot of time to get that reputation back. Would that be a fair assessment?
Adam, I apologize, everyone. I have an 11 o'clock. So Nate, Carl, pleasure to meet. Adam, thank you for inviting me. I'm sorry I have to take this one.
Yeah, no,
enjoy. Have a great day. Cheers.
I'll give a thanks, Greg. Just a quick answer. I think what I would say is people are beginning. It's the trading versus raising capital. I think what you're seeing is people moving into some of these names, and on the mining side, on the junior space, you're probably seeing some of that driven on the retail side, frankly, because these companies don't have huge amount of float, and so it doesn't take a lot to move those share prices. It's another thing altogether when you're trying to go raise primary capital. And the issue for a lot of the juniors is that the amount of capital that they have to raise, even in today's market, relative to their market cap, is significant. So, I don't know that a junior could go raise 100 or 200 million in pure equity as primary capital today for a project, despite the fact that their share prices have performed pretty well. And I agree with what I think Nathan was talking about earlier. I think initially what you're going to see is a lot of enthusiasm around the more established names. And, you're going to see some punters, frankly, on the juniors sort of playing that sector, but that's a very different thing from raising primary capital.
Certainly. So would I be right in sort of summarizing it? We've got the wind in our sails in a sense. It's not a bad period that we're coming into, but certainly challenges around meeting the demand and keeping the capital flows going as we move forward with this new kind of era.
Yeah, I think, and there's going to be there's going to be a ton of opportunities. And I think you have to think about, you have to break down some of the longer term trends into, shorter periods. 10 or 20-year trends need to be looked at in 2 or 3 year periods to see how quickly reaction can happen and where the holes are in those.
Okay, and just to wrap us up, other than copper, do you have a bullish a metal that you're most bullish on in the near term? PGMs or some other metal that's going to perform quite well?
In addition to copper, we like copper a lot. We like tin a lot.
Tin, yeah.
As I said, I think the fundamentals around metallurgical coal are pretty strong. And then, some of the more specialty metals and additives, like if you look at something like niobium, for example, where, that's a steel strengthener. And so it becomes very important for, contributing to light vehicles, which becomes very important for an electric vehicle. That space is a little dominated right now, but there are some newer entrants coming in. That's probably top of mind for us right now.
Interesting.
Yeah, listen, the other one I would add real quickly, Adam, is aluminum. We think is pretty compelling here. Obviously aluminum margins are very good. If you buy into what China has said in their recent 5-year plan of decarbonization and the natural evolution of them not exporting cheap and dirty energy via exporting steel and aluminum, it makes a ton of sense that we've gotten almost all the supply growth from China in aluminum over the last 15 years as the market's doubled in size. And building a smelter in the Western world will have a lot of challenges. And, we think aluminum will be part of what's changing is demand intensive on the energy transition for aluminum. And we think it'll be part of the solution for copper.
Fantastic. Okay, that's taken us to time, gentlemen. Thank you very much for providing your insights.
Thank you, Adam. Thanks, Nate.
Thanks for having us, Adam.
All right.
Appreciate it.
Take care. Bye-bye.